Welcome, everyone. Today, we are exploring a critical transformation in global finance, the drivers and benefits of Treasury centralization. We will examine how fragmented local operations are evolving into strategic, unified financial hubs. Let's get started. Welcome to Slide 1. Let's define what Treasury centralization is. In essence, it is the consolidation of Treasury units and services from various geographic subsidiaries into a single, unified location. The basics involve taking autonomous, fragmented local processes like funding and cash management and standardizing them under a global or regional hub. Why do this? As companies expand globally, managing cash across diverse currencies and banking partners creates massive complexity and risk. How is it done? By pulling accounts, systems, and decision-making into a central node. Our deep dive reveals that centralization isn't just about changing locations. It is about gaining absolute visibility over the firm's global liquidity, turning a fragmented back office into a strategic powerhouse. Looking at this diagram, on the left, we see a decentralized model where every business unit operates independently, creating a tangled web of inefficiencies and hidden risks. On the bottom, the centralized model funnels all these business units into a single global treasury center. This hub now acts as the central brain, coordinating all cash flows, harmonizing policies, and acting as the single point of truth for the organization's liquidity and efficiency. On Slide 2, we explore the core drivers of centralization. What exactly pushes a firm to centralize? The basics include skyrocketing transaction volumes, expanding geographical footprints, and the sheer complexity of modern corporate finance. Why does decentralization fail at scale? Because it makes it nearly impossible to monitor global credit risk, enforce standard policies, or even see how much cash the corporate group truly holds. How does the shift begin? Often after rapid growth, mergers, or when market turbulence strikes. In our deep dive, we see that systemic shocks, like the global financial crisis, acted as major drivers. They forced companies to tighten internal controls and mobilize their own internal funds rather than relying on expensive external bank liquidity. This flowchart illustrates the primary drivers funneling into Treasury centralization. At the top, we have global expansion and M&A activity increasing complexity. On the left, the need for risk management and compliance drives the need for control. On the right, the push for operational efficiency and cost reduction demands streamlined systems. All these forces converge on the central diamond, making Treasury centralization a strategic necessity that ultimately leads to strategic enterprise control. Moving to Slide 3, let's look at the immense strategic and financial benefits. What do companies actually gain? The basics are massive economies of scale, lower banking fees, and optimized foreign exchange margins. Why is this so powerful? Imagine one subsidiary in Europe has a cash surplus, while another in Asia has a deficit. In a decentralized setup, Asia borrows externally at high rates while Europe earns minimal interest. Centralization allows the firm to offset these balances internally, slashing external debt costs. How is this achieved? Through bank account rationalization and leveraging the group's massive purchasing power. For our deep dive, consider FX netting. By consolidating global exposures, a centralized treasury mathematically nets out offsetting currency needs, drastically reducing the volume of market transactions and saving millions in bid-offer spreads. This mind map breaks down the benefits into three main branches. First, financial benefits. We see reduced borrowing costs, minimized FX spreads, and optimized working capital. Second, operational benefits, standardized processes, reduced bank accounts, and fewer manual errors. Finally, strategic benefits, absolute cash visibility, enhanced risk governance, and real-time decision support. Together, they transform the Treasury from a cost center into a value driver. Slide 4 details how the Treasury operating models. What are these structures? They are the architectural blueprints of centralization. The basics range from shared service centers, or SSCs, to regional treasury centers, and finally, the in-house bank. Why choose one over the other? Because every firm has unique geographical, cultural, and regulatory constraints that dictate the optimal fit. How do they differ? An SSC typically handles high-volume, low-complexity tasks like payment processing. An in-house bank, however, acts as the actual bank for all corporate subsidiaries. In our deep dive, the in-house bank represents the pinnacle of centralization. Subsidiaries no longer go to external banks for loans or FX. They transact exclusively with the in-house bank, which centralizes the group's entire market risk and liquidity management into a single control tower. Here we compare the three main models on a spectrum of complexity and value add. At the base, the shared service center focuses on transactional efficiency, processing payments and receivables. Moving up, the regional Treasury center handles regional liquidity and FX execution, acting as an advisory hub. At the pinnacle is the in-house bank, managing intercompany loans, centralized funding, and comprehensive market risk. Each step upward represents deeper centralization and greater strategic control. On slide 5, we dive into the true mechanics of centralization, pooling, and netting. What are these? They are the core techniques used to squeeze every ounce of efficiency out of group cash. The basics of pooling. Physical pooling physically sweeps subsidiary cash into a master zero balance account, while notional pooling allows the bank to virtually offset balances for interest calculation without physically moving the funds. Why use netting? To drastically cut down the number of intercompany payments. How does it work? Instead of subsidiaries paying each other back and forth across borders, a netting center calculates who owes what and executes a single net settlement. Our deep dive proves the math. A complex web of 14 global intercompany invoices can be mathematically reduced to just a single net transfer, virtually eliminating FX conversion and transaction fees. This diagram illustrates the mechanics of cash pooling. On the left, subsidiary A ends the day with a surplus of 100, while subsidiary B has a deficit of 40. Both balances are swept into the master zero balance account in the center. The surplus internally funds the deficit, completely neutralizing the overdraft. This leaves a net positive balance of 60, which is then automatically pushed into an overnight investment to earn interest. Highly efficient and cost-effective. Slide 6 addresses the enabler, technology and system integration. What makes centralization possible? A robust treasury management system, or TMS, connected globally. The basics involve moving away from manual, risky spreadsheets to automated systems. Why? Because centralizing thousands of global transactions manually invites catastrophic errors and fraud. How do we integrate? Through APIs and Swift networks. Look at our sample code concept. This JSON payload represents an API call from a centralized TMS to a global bank to initiate a payment, specifying the debtor, exact amount, and currency. In our deep dive, we see that initiatives like the Common Global Implementation, or CGI, allow a central treasury to send a single standard message format like the ISO 20022 pane.001 XML file to multiple different banks globally, achieving true, error-free straight-through processing. This sequence diagram walks through straight-through processing via technology integration. First, the local ERP sends approved invoice data to the central TMS. The TMS instantly aggregates this and fires an API or ISO 20022 XML message directly to the global bank's gateway. The bank executes the payment and returns a real-time status confirmation. Finally, the central TMS updates the local ERP ledger. This is seamless, secure, and requires zero manual intervention. Let's explore a highly relevant, real-time use case on slide 7, overcoming implementation hurdles. What happens when you actually try to centralize a massive global firm? You hit roadblocks. The use case involves a global manufacturer attempting to consolidate cash, only to face fierce resistance from local subsidiary managers. Why the pushback? Local CFOs fear losing their autonomy. They worry that a central hub thousands of miles away will fail to execute critical local tasks, like payroll, on time. How do successful treasurers solve this? By implementing bulletproof service-level agreements and ensuring the central system interfaces flawlessly with local clearing networks. Our deep dive reveals that migrating from 150 fragmented local bank relationships to just a few global partners requires securing local liquidity lines, over-communicating, and proving to local teams that centralizing actually makes their jobs easier. This flowchart maps the resolution of implementation hurdles. It starts with the centralization announcement, which splits into two main roadblocks: local resistance due to fear of lost autonomy, and operational fears like payroll delays. We apply targeted solutions. Executive buy-in and communication tackles the autonomy fear, while robust SLAs and local clearing integration solve operational worries. Both pathways successfully converge on the ultimate goal: successful centralized model adoption. Finally, on slide 8, we look to the future of centralized treasury. What is the ultimate destination? The centralized treasury is rapidly evolving into a digitally native strategic control tower. The basics involve shifting from historical, hindsight reporting to real-time predictive foresight. Why is this critical? Because navigating today's economic volatility requires proactive, data-driven decision support. How will we get there? By employing hybrid models that utilize offshore global capability centers and leveraging artificial intelligence for highly accurate cash forecasting and anomaly detection. To stay relevant, you must master these digital transformation concepts. I want to invite all learners to like this video, subscribe to our channel, and visit quicktechie.com for premium certification prep. At quicktechie.com, you'll find comprehensive Q&A banks, full ebooks, audiobooks, full-length training courses, and interview guides to accelerate your Treasury career. Thank you for joining me, and I'll see you in the next session. Our final diagram visualizes the Treasury of 2030. At the center is the Treasury 2030 Strategic Control Tower. Feeding into it are three critical pillars: next-gen technology featuring AI and APIs, hybrid talent emphasizing cross-functional skills, and advanced operating models like global capability centers. When these combine, they output the ultimate goal at the bottom: predictive intelligence and massive enterprise value. Thank you for watching.